Hey students, this is Matthew Wynn with FAU. Today we're going to be going over a discounted cash flow analysis based on a case that I came up with. We're going to take into account forecasting all three financial statements. We're going to do a free cash flow. We're going to do a WACC analysis. We're going to solve for WACC. We're going to get a business valuation by then applying the WACC to our discounted cash flow analysis of our free cash flows. Let's get started and let's jump right into the case and let's get it done. We're going to go from A to Z so you guys are prepared for solving for a business valuation by doing a discounted cash flow. Alrighty, everyone, we're going to keep this super candid. Let's jump into the other screen real quick. So let's read through this case. I'll give you guys a second, and if you guys are watching this video, you most likely already have this case. So case study on EV fire blankets. EV fire blankets, specialized car fire blankets. Introduction. EV Fire Blankets is a customized company specializing in the production of specialized car blankets designed for fire safety in vehicles. Given increased awareness and regulations surrounding fire safety in automobiles, the company is looking to secure additional funding for expansion and product development. EV Fire Blankets have established itself as a reputable player in the automotive safety industry. The company's specialized car blankets have been well received by consumers and are designed to effectively mitigate fire risks in vehicles. EV Fire Blankets operates with strong commitment to innovation and safety standards. As a financial analyst, your role is to conduct a DCF for this company. To pursue with the DCF analysis, we need to gather specific financial data, including revenue projections, operating expenses, capital expenditure forecasts. Additionally, we should focus on market growth, competition, potential risks with specialized car blanket industries. Once we have this, we'll calculate the percentage of the company that has to be offered to investors and develop a comprehensive financial investment proposal. If you have any additional details or specific financial data related to EV Fire Blankets, please provide them. We can delve deeper into the analysis and determine the optimal investment options for the company's expansion. All right, a whole bunch of mumbo jumbo. In totality, what we need to do is we need to do a free cash flow forecast and get our discounted cash flow, and we'll do a valuation on the EBITDA multiple method, and then we'll do the perpetuity growth method. So we got an email from our CFO. Fantastic. Hey, analyst, I hope your week is going well. I'm sending you the request from Miss Atlantic, our CFO. Let's assume we are in the beginning of 2023 for the forecast period. We have another analyst on this project that was able to compile some of the information in the Excel file attached, and you'll see the assumptions listed on the Assumptions tab. The following steps we would like you to complete. Finalize the projected income, balance sheet, and cash flows. Use a mix of historicals and ratios to find the missing line items. Find our WACC and our EV to EBITDA multiple based on market research and then comparable company data provided as well. You can use the links attached to find the cost of debt and cost of equity as well as the weights for each. Forecast the free cash flows. Perform a discounted cash flow analysis. Use perpetuity growth method and EBITDA multiple method to get a valuation. The assumptions will be attached to the Excel sheet. Additions to PP&E along with depreciation assumptions are given, and long-term debt assumptions are given as well. In this case, let's assume we do not have to pay back our debt in the forecast period. Common stock won't change. We can also assume that other current assets and other current liabilities won't change as well. The end goal. We want to get a valuation of the company, determine at investment dollars what would the investor get with regards to stake in the EV Fire Blanket company. You need to determine our enterprise value first. I'm attaching the spreadsheet below with some historical financials. Thank you. All right, let's get started. So I have the assumptions pulled up here on our case. So on a brief look, let's take a look at all of the stuff that we have here. We have the project assumptions. We have to solve for the WACC. We'll have to solve for the EBITDA multiple. The perpetuity growth rate is given. That's an assumption. So we're going to say that after X amount of years, we're going to grow in perpetuity at 3%. The perpetuity multiple we will also solve for once we get our WACC. Our tax rate is 21%, and our target debt to equity is 15%. That's given as well. All right, so let's just take a quick look around to see what we have going on here, guys. Let's look at the income statement. We have the historical income statement here. We also have the balance sheet plus the cash flows. So we have our cash flows there, and we have our balance sheet. I will change this to one color. All right, we found our first hiccup. Comparable comps, so they gave us a bunch of stuff. So let's take a look at this. After we do our income statement, balance sheet, and regular cash flows, So I'll walk you guys through how to get the relevered beta, the EBITDA multiples, and these are the comparable companies we decided to use: Honeywell, Johnson Controls, RTX Corp. And it looks like we have some of the data pulled up here, and we have all of the data here for the stock market. Okay. Our free cash flows, we have it semi-built out. We have our historicals, and then we have our discounted cash flow dashboard where we'll fill in the blanks to get the information provided here. Okay, so let's start with our income statement. We know that we have sales, cost of goods sold, gross profit, R&D, SG&A, and travel and entertainment. Let's take a look and do this quickly. So we have some historical assumptions here, but it looks like they've given us what they want us to forecast of. So let's just do the sales real quick. So when we go here, we know that our sales are going to grow by 1 plus the growth rate here. So the growth rate is 20%. Let's copy this. So we know that we're going to multiply D8. And if we pull this over, it should work out nicely. Okay, cool. Everything looks good there. Let's do the same for cost of goods sold. So our cost of goods sold is going to be a percentage of our sales. So it'll be 20% of sales. Let's lock down the column here. The row, apologies. That way we can just pull this over. Let's also lock down. Actually, nope. We're good here. So let's pull this over. All right. We're getting somewhere. Now, gross profit is just equal to our sales minus our COGS. So we'll multiply that or subtract that. We'll pull that over. All right, SG&A. Let's copy this. Let's see if this works. All right, it's looking good. And we should be able to pull this down. Looks like we're off by 1. Okay. So what we'll do here is we'll go back. It should be F16. So we'll just change this to F16. And we'll pull this down. We lock that the sales number. So that should be good. Pull this over. All right, our total operating expenses. Let's do a sum of all these. Let's copy, paste that. Let's get our earnings before interest, taxes, and depreciation and amortization. So we'll take our gross profit, subtract that out from our OpEx. Let's pull this over. Okay, everything's looking good. Okay, so our depreciation in this case, let's take the assumption they gave us. They gave us our depreciation expense. So let's pull this over. Okay, looking good. Let's get our EBIT. Looks like they already have it calculated here, but I'm just going to do it anyway. So we'll do this minus this. Let's pull this over. We know our tax rate is not going to change, so let's just multiply this by our tax rate. Let's lock that tax rate in. We'll pull this out. And then it should just be this minus this. Okay, perfect. All right, looking good. Income statement is done. Let's look at the balance sheet. Okay, balance sheet. So our cash, we're going to solve for that later. Our accounts receivable, there's a note here. So let's copy this actually and put it on our assumptions page. So we'll take our days in AR. So what are we going to do? We're going to take accounts receivable. We'll take the ending balance. You can either do an average or the ending balance. We'll take the ending balance, divide this by our sales, divided by 365. Should give us our, oops. Why is it complaining? Oh, it's an extra one here. So we get 109, and I think I should be able to pull that over. Okay, let's do our days in inventory. So we'll take our inventory, ending inventory. We'll divide that by our COGS divided by 365. Okay, so we got our days in inventory. Let me clean up these decimal points so they're all cohesive. So, okay, 2 decimal places is good. Let's do the same thing with our payables. So let's go to our balance sheet. Let's get our accounts payable. Let's divide that by our COGS. Oops. Our COGS again, divided by 365. Let's get these days. Okay. So let's format this. Let's get our cash conversion cycle because why not? So do, and then plus or minus C32. All right, we got our cash conversion cycle, and I'm actually going to take this and paste it back because what we are doing here is we are, or actually I'm just going to delete this out of here. Clear contents. Okay. All right. Okay, so for our accounts receivable, go back to assumptions. Let's get an average here. So what we're going to do is we're going to apply these ratios to our sales numbers to give us a accurate picture on how we can forecast these line items rather than just doing them as a percentage. We're going to forecast them based on the average. So since we already did the sales, now what we have to do is to find our AR, we have to do our sales divided by 365 and multiply them by the number of days. All right, so let's do that. All right, so our AR, let's do our sales. So let's go back here, income statement. Let's go to sales. Let's parentheses here. Divided by 365. And then let's multiply this by our days. Let's lock this down. So be our ratio factor here. That'll get us our forecasted AR. So let's do this. Looking good, looking good. All right, let's do our inventory next. So inventory is going to be we'll go to our COGS. Divided by 365, throw this in parentheses. Multiply this by average days. Multiply this by average days. Okay, that looks good. Oops, I forgot to lock it. Let's lock this down. Okay, looking good, looking good. Let's go to our accounts payable. So we're going to do the same thing. Let's do our COGS. Divided by 365. And there's probably a faster way of doing this. I just want to show you guys what I'm exactly doing. Could probably just make some mixed references and then be able to complete that that way. So we'll do that. We'll multiply this by our average days payable here. Looking fantastic. We'll pull this out. Okay, oops, I forgot to lock it again. So we'll lock this. And we will pull this over. All right, so what's next? We know our other current assets are going to remain the same based on the case, so let's just do this. Let's copy this over. Same thing with our other current liabilities. So let's take this and let's copy it over. That's interesting. They're both the same number. All right, so what's next? Okay. Current liabilities, let's just do this real quick. So it's going to be the sum of this. This is like a mini balance sheet. There's obviously in practice going to be a lot more numbers, but we're trying to get this done quickly and effectively to show you guys how to do things so you can apply this for when you are doing your thing. So let's copy this over. We don't have cash yet. We're going to wait to do our cash flows for that. All right, PPE, looks like we have additions on our assumptions. So let's just add this to our PPE assumptions. We're going to go up, or CapEx, same thing. We're assuming that CapEx is going to be the only additions they have. And we know that our accumulated depreciation is going to be, it's just going to be this plus the depreciation assumptions. So quick tangent, in practice, the best way to do this is to create your own depreciation schedule and have your total assets and then any purchases you're going to buy and then depreciate them and then come up with a schedule. The same thing with loan and loan payments. In this case, we're not doing that. So we'll take the net of these. Okay. So kind of similar for loans. So what you'll do for loans in practice, most likely, unless it's a quick and dirty or it's a newer company, is you'll have a loan schedule and you'll apply that to your financial statements. But in this case, we're going to teach you guys the model mechanics, and then we will move on into actually how to do the valuation. So let's do it. All right, accounts payable. We have our current liabilities. Our long-term debt is going to be increased the same way. Looks like we got a nice little debt here where we're not going to have any interest. So looks good to me. I like that. So our debt will stay the same. Total liabilities, we'll take our current liabilities, add that to our long-term liabilities. Look good. They said common stock is going to remain the same. We're not paying any dividends. So our retained earnings is just going to be our last year retained earnings plus the net income for that year. Okay, that looks good. All right, let's add these together. This plus this. Looking good. All right. So looks like we're out of whack by 10,000. So basically, this is just a little formula to check if it's okay or not okay. If there's a balance here. So let's take a look at our cash flows now. So let's go to our cash flows. Let's do our net income. So we'll take our net income from that year. We will add back our depreciation for that year. Oops, I didn't mean to do that. Let's just pull this over. Let's take our depreciation from our income statement. And then let's find our changes in working capital. So this is going to be the fun stuff. All right, so what we're going to do is we're going to take our net working capital. So let's take our prior year. So we'll do the sum of the prior year. So we'll do our sum of our AR and our inventory. Or we could just do this. Boom. Minus our current liabilities. Right. And then we'll subtract that out from this year's sum of current assets minus our current liabilities. That should get us the change in our net working capital. All right, let's pull this over. All right, so cash flow from operations. Let's pull this over. Looking good. We have 0 common stock, so we can actually just zero this out. Or you can reference the common stock, but that's fine. Issuance of debt. So we'll take our current debt amount, subtract it out from our prior year to get our current debt. And remember, debt is going to increase our cash. So when we issue debt, we're going to have more cash. All right. Payment of debt. We're not paying any debt. We're lucky. So like I said, if you had something like this in practice and you'd want to calculate your payments of debt, you will make a schedule where you do your debt and you pay the debt off, and that will impact the cash flow. But for now, this is good. So we'll do a sum of this, and you would decrease your cash flow as you pay debt off, obviously, right? Okay. All right, let's take our CapEx. So what we're going to do is we're going to take the same thing. We're going to take our PP&E. This is going to be our only CapEx in this case. We're going to subtract it from our prior year. And we'll make this a negative since we know that's a deduction from cash flow. Pull this over. And because I like to be consistent, I'm going to take this and I'm going to make it the same. We're not going to sell any PP&E, so we'll do that. All right. And I think that's already built in, so we'll just pull that over, just a sum. So we know our additions to cash is going to be the sum total of all this. So boom, boom, boom. We'll take our beginning balance, which would be last year's ending balance, and we'll do the sum of this and this. All right. And our cash should equal this. All right, it balanced out. Good to go. Now, say our prayers and let's copy it over. So, let's copy this over. Let's copy this over. It should check out. All right, we balanced. Let's go. All right, so we got our 3 financial statements forecasted. Next is going to be doing a free cash flow. And then from there, we're going to go and get our WACC, and then we'll find our discounted cash flow, and we'll get ready to close this thing out. All right, guys, so we're here at our free cash flows. We have our EBIT from the income statement. We want to take out taxes, so we're going to go to the income statement, find the taxes for that year. We want to add back depreciation, so we can take that from the income statement here. We want to take out any capital expenditures. So we'll go to the balance sheet, and we'll go to our CapEx. And then we will also take out any changes to net working capital. Go to our balance sheet again and cash flows. And our cash flows, we will take the changes in working capital. All right, so we're going to subtract out the taxes, add back depreciation, then add back those last 2 items of CapEx and the change to working capital since they're already negative. So let's pull this over. We got our free cash flows. Now we have our discounted cash flow model. From here, we're going to take our free cash flows, and then we have to find a discounted value. So what can we do to get our discounted value? Let's go to our comps model. So essentially what we have here is we have a dashboard that was partially complete, and we're looking to find this WACC right here. We're looking to find this WACC. So let's get our beta first. So we have our stocks here. We have their beta, we have their market cap, their total cash, and their total debt. So what we can do here is just get their total net debt. So it'll just be the cash or the debt minus the cash. We will do that. Pull that down. Oops. Take these out. All right. We got the tax rate. So to get the delevered beta or the unlevered beta, we're going to take our normal beta that's in B71. We're going to divide that by 1 plus 1 minus the tax rate. The tax rate is 21%, as you guys see here. And then we're going to multiply that by the debt to equity. And then in order to get the debt to equity, we're going to take the net debt from this specific company. and we're going to divide that by the total net market cap, and that will get us the delevered beta. It's a good estimation. We'll get an average here, so we'll do average of these. And in order to get the relevered beta, we're going to take this average and we're going to relever the beta. So we're going to do this 1 plus 1 minus the tax rate. And then we're going to multiply it by our targeted debt to equity. And now, guys, the reason why I'm doing it this way is to show you guys how you could calculate it. Most of the time, you're going to get an assumption for the WACC, but I'm walking you guys through some of the steps of how to calculate this yourself. So we should have it as 1.07. What we're going to do here next is we're going to get the total enterprise value. So in order to get the total enterprise value, we're going to add the market cap by the net debt. So we'll do this plus the net debt. I think I added a little mistake. There we go. So we get this. It's formatted in this number format. Let me change this so you guys can see. Basically here I just did a lookup on the stock ticker, and there's a bunch of financial data down here, a bunch of stuff. So feel free to poke around there. All right, so we're going to get the debt divided by the debt to equity. So we're going to get our weighted debt, or our assumed weighted debt. So it's going to be this divided by the total enterprise value plus the market cap, 57%. And then the opposite for the equity to debt. So we're going to do, could just do 1 minus this. Get these. These are just assumptions for our weighted debt since we don't have stocks or anything like that. So we'll just take a high for each. So we'll do max this. We'll lock. We'll lock this. So we'll lock this into place. We'll pull this down. We'll pull all of these over. That'll get us our weights for our debt and equity. So let's fill these out. So the cost of equity is now going to be equal to. So to get the cost of equity, we're going to take the 10-year risk-free rate, which is assumed to be the real risk-free rate in this case, and we're going to take beta, and we're going to multiply it by the market risk premium, which is just the expected return minus the risk-free rate. You can use a nominal rate and get the risk-free rate from there. But for now, this is going to be good. We'll just take the Treasury yield bond as the risk-free rate. Now we have that. We have our average debt to capitalization, average equity to capitalization. And now we can solve for our WACC. So in order to get our WACC, what we're going to do is we're going to take the cost of debt, which we're going to be using an assumption from the cost of borrowing from the Federal Reserve. And we're going to multiply that by 1 minus the tax rate. And then we're going to multiply this by the weighted debt. And then we're going to add this to the cost of equity times the weight of the equity. That gets us 8%. So our WACC is going to be 8%, or 8.545%. Okay? So we'll go back to our assumptions. And now our WACC will be equal to 8.45%. Okay. EBITDA multiple. All right, EBITDA multiple, let's do that. So for our EBITDA multiple, what we're going to do is we're going to go down to our comparable companies. We have our enterprise value and we have our EBITDA. So let's just divide these together. This by this. Enter. So let's take this. Let's pull this down. So we have all the multiples there. Let's get again the high, the low. So let's do max. Let's lock these in. And now I'm going to lock these down. Okay. And I have a number format to get that little X if you want to see how to do that. Go to more number formats and go to custom and just do number X, money sign, quotes X. So we have our multiples here. Let's do the low now. So let's do the min. Let's do the min. Let's do the median. And let's do the average. And we're going to use the average here. So we have 17X. So I had this already filled out, or I guess our analyst had this filled out. So what I usually do for private companies is apply a discount rate. So this is an assumption here. This is an assumption saying that because it's a private company, it's most likely going to be less liquid. So discount rate, it's probably not the best term. This is called an illiquidity premium. And now we have our EBITDA multiple, 11.96x. So we can solve for that. We solve for that. So let's pull that in to our assumptions page. And now we can solve for the perpetuity multiple. So the perpetuity multiple, we're going to solve for that by taking 1 plus our perpetuity growth rate. So how much we're going to grow in continuum. And now we're going to divide that by our WACC minus that growth rate, right? All right, so we get 17.22x growth in perpetuity. All right, now we're on to the last part, our discounted cash flow. So all I did here was bring in the cash flows from our free cash flows. Let's take our discounted value. So we can do a present value. Our rate is going to be our WACC. It's going to be our WACC. We can lock this one in. Number of periods is going to be just 1. This is going to be the first period. We are not going to have a payment, and we know our future value will be equal to negative this. Okay, so we can pull this over. And now we have our present value, or the sum of the free cash flows that are discounted. So we can either sum that, or we can even just do this. So sum of discounted, this would be the same. So you can just do PV. The rate will be our WACC. The rate will be our WACC. Our NPV. Sorry. And we'll take our free cash flows. And that will be our that will be our the same number. Okay, so what do we do next? So we take our sum of our free cash flows. We'll take the last forecasted cash flow. We'll multiply this by our perpetuity multiple on our assumptions page. All right, and then we'll get the present value of this. So we'll say PV. We're going to take, again, the WACC, and I could probably name this, but it's fine for now. We'll take that. Next will be the number of periods. So it'll be the 5th period. We're not going to have a payment, so do 2 commas. And we'll take our future value. Our future value will be our terminal value here. And we'll make this negative. And then what we want to do is we want to add our last forecasted cash flow, and we want to add that to our present value of our terminal value. That'll give us an enterprise value. Next, we're going to do the same thing. So we're going to take the last forecasted cash flow. Next, we're going to take the sum of the free cash flows. We're going to get our last forecasted EBITDA. Go to our income statement, get the last EBITDA. We'll get the terminal value of this. So we're going to take that multiplier that we did before. Assumptions. Except it's not going to be the perpetuity multiple. Now it'll be the EBITDA multiple. And we're going to get the present value of that terminal value. And in order to do that, we need to get the same formula here. So let's see if this works. Do this again. And that's it. So we get our average. Let's take a valuation of both. We'll do an average of these two. They're pretty close, right? So I think the case states that the investment would be at this level, but these are in, this is in millions and these are in thousands. So let's copy this. Actually, it'll be, so investment options. So 10,000 will be 10 million, 15,000 will be 15 million, and then I think it's 17.5 will be 17.5 will be option 1. I guess these would be switched. And then we can say proposed share percentage. So we'll take this, divide by our average valuation. We'll lock that one into place. And we'll pull this down. Make this a percentage. So at these numbers, so at the 10 million, it'll be worth 7% of the company, 15 million will be worth 11%, and 17.5 will be worth 13%. All right, guys, I hope you guys enjoyed this video and this comprehensive guide on how to go over a discounted cash flow using the EBITDA multiple method and the perpetuity growth method and the forecasted financial statements. If you guys have any questions, please feel free to reach out to me at Matthew, NGUYE 2023 at FAU.edu. So in this video, we went over how to perform a discounted cash flow, forecasting the financial statements, going to a free cash flow, then doing a discounted cash flow. We found out how to get a WACC based on using some comparable companies and doing an analysis on their financials. This is not financial advice or financial help, so make sure to be cautious when you do this in practice. And like I mentioned many times in the video, a lot of times there will be some more complex financial calculations that you'll have to place in order to do a real valuation of a company, but this is definitely a great start and a good framework for you guys to use in the future for any projects. Take care and have a great rest of your day.